From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, cooling inflation data is adding to the case for Fed easing. But strong spending and GDP points to a soft landing and keeps the rate debate alive. And red-hot issuance continues around the world. We begin, though, with the big issue. The soft landing chorus grows.
There's improving prospects for a soft landing.
Soft landing? Soft landing.
This Goldilocks scenario, perhaps.
This perfect Goldilocks scenario.
Growth being a bit stronger and more resilient. Inflation still coming down.
U.S. economy is still fairly robust. We're looking at the data, and the data looks strong.
But we do expect growth to remain positive.
We do think inflation's going to come down.
Inflation's coming down decisively.
To get inflation at 2%, you need everything to behave really well.
Everyone believes that the next move by the Fed is a cut.
The question is when and by how much.
Baseline, I think you still need the economy to cool to get the Fed to cut.
What gets them to cut in March is the inflation data.
The catalyst for the Fed cutting rates is that, you've got real rates now heading towards, levels that are really restrictive.
They're going to be taking a read on that macro outlook to figure out when to cut rates.
Now let's take a look at the latest inflation data that we just got this morning, and that is the PCE. When we're looking at the Fed's preferred gauge of inflation, you are looking at it cool to levels that are almost as low as it's been in 3 years. And you just see that massive jump you've seen from the highs to the lows, and it does build that case for this idea that the Fed can start to get nearer to potentially declaring victory and then bring rates lower along with it. The question, though, is how much, especially with strong economic data. I do want to pull up the board here because you do see that push-pull here in forces, and you see it in the difference between the 2-year and the 10-year yields. You look at the 2-year, for example, this blue line here just really cooling. Yes, it's off the lows, but you are meaningfully lower than where we were even 6 months ago and certainly where we were from the highs. The 10-year, however, you're looking at a rise higher. And it's an interesting conundrum when you think about other forces. For example, Treasury issuance that we are going to see the schedule for in the coming days just ahead. And this week, I caught up with Blackstone President Jonathan Gray, and he gave his take on the Fed's path ahead.
My gut is they will cut rates. The question is, will they do it as quickly and as deeply as the market wants? That's hard to say, but I think the direction of travel is pretty clear because there's good news on the inflation front.
Joining us now is Peter Cecchini of Axonic Capital and Ira Jersey of Bloomberg Intelligence. We got the data. We have that PC in preferred gauge of inflation. But when we look at the Fed meeting going into next week, that dot plot and the expectations for the path forward, Ira, maybe set us up here on Bloomberg Intelligence's expectations on perhaps how the market might diverge from the Fed.
Yeah, so I think that the market is kind of almost front-running the Fed a little bit here, thinking that there's going to be more than 100 basis points of interest rate cuts during the course of this year. And I think that will continue until and unless the Federal Reserve actually skips a meeting when it finally starts its round of cuts. So, for example, our expectation is that the Federal Reserve will start cutting interest rates in May, but then will skip June, right? So if it goes in May and skips June, that's the time when the market will start to say, okay, maybe they're not going to go 25 basis points every meeting. It's going to be on a different cadence than that, and then the market will readjust pretty dramatically. But until then, I think the market's likely to think that once they start cutting, they're going to keep going, at least at some slow pace, like 25 basis points a meeting.
Let's get tactical here, Peter. If you're an investor, how do you think about positioning along the curve heading into some serious data points?
Well, I think the biggest question that everyone needs to answer going into this year is, why is the Fed going to cut rates? I think there's a consensus that the Fed will cut. Fed funds futures are pricing in about 135 basis points of cuts this year. But the most important question to be able to answer is that because the Fed's going to be able to manage to a soft landing, or is that because there will be an economic slowdown later in the year? And for us at Axonic, it feels like the latter. The average number of cuts in a recession year is about 200 basis points. And we almost got there a few weeks ago. And so no one should really be surprised that inflation is cooling either. I mean, that's a great thing. But the question is inflation cooling because the economy is slowing? And quite frankly, I think people's read on the economy is being influenced by asset prices quite a bit, because indeed, I think I can read in a number of different cracks in the data as the year has progressed. And I think the consumer has been spending well above what it's been earning, and that's not sustainable either.
Ira, if you think about the strong economic data we've seen, for example, in spending and in GDP, do you think that holds, and does it hold enough to have the markets declare victory on the idea of a soft landing or even no recession?
Well, I think the issue with the data right now is that, going into the year, we obviously had a pretty decent fourth quarter. But as Peter mentioned, if we do start to see a slowing in things like spending growth because people have paid down their savings and they're not borrowing more money because of higher interest rates or just too much leverage themselves, then clearly you can get that slower economic activity. But nonetheless, the reason why, and my view is that we might be able to avoid a technical recession, maybe not. But that's a little bit less important than ultimately the pace and how the Federal Reserve views that. And I think that the Federal Reserve is going to be very beholden to the inflation data. And if the inflation data holds where it is, and in your pre-roll there, you mentioned, there was someone who mentioned the idea that the real Fed funds rate is getting very high now. And that's true. And I think that's the way the Fed looks at it. So that's one reason why, even if we don't go into a recession and inflation remains low, the Fed can cut incrementally just to get that real Fed funds rate. So the Fed funds rate minus the PCE deflator, move that lower instead of having that continue to be at 250 basis points. Maybe they only wanted a 200 basis points. So that they can move it down and calibrate it is the operative word that I think you want to listen for Jay Powell next week to say, which is echoing what Waller said last week and is a little bit different than what Powell even said at the December meeting.
Now, I want to bring in a point that you were making, Peter, this idea that asset prices are not quite responding to any of the potential issues ahead. Now, Guggenheim was weighing on the impact of Fed policy, writing that investors should bear in mind the cumulative impact of the change in interest rates since the Fed started tightening. Because even if rates fall from here, we do not see them returning to the lows of the prior cycle. And the market's exuberant response must be balanced against downside risks. Where do you find, Peter, those downside risks?
Well, that's an interesting take. I tend to agree with it. I mean, one of the things we have to keep in mind is that we've really come to the end of a 40-plus year of a secular bull market in bonds, and it's going to be very hard for the Fed to accommodate quickly enough in the case of a slowdown in the way it has in past cycles, where the Fed has typically cut more and cut below the lowest Fed funds rate in the previous cycle. So that cushion no longer exists, and is often the case to some of Ira's points, which are often on point. There was a Jim Reed piece from Deutsche Bank that came out recently that said, everything points to a soft landing, ... except history. And so, the risks are there relative to history. The Fed has, generally speaking, not been able to orchestrate the soft landings. And the average recession comes about 14 months after a 3-month 10-year curve inversion. And we're at about that right now. So we were a little early on our prediction because we failed to appreciate the impact of fiscal policy coming out of the pandemic. But certainly it would seem sort of premature to throw in the towel on at least the possibility of the slowdown that history suggests is going to happen sometime in the near future.
Speaking of the curve, as we had been at the beginning here, Ira, you think about auction sizes, record auction sizes, already the 2-year and the 5-year hitting peak records. And you think about the announcement that's coming just on Monday from the Treasury Department and the future issuance schedule. How does that have the potential to really start to impact the longer ends of the curve here?
Well, I think there's multiple pieces to that discussion and how the market may react to the information that's going to come in. So first, remember, Monday afternoon, we get the amount that the Treasury Department expects to fund this current quarter. They basically have 2 more months of the quarter to fund, plus what they expect to have to do in the next quarter, so the April through June quarter. And then more important to that, and I think what will be market moving and what has been market moving the last couple of refunding announcements is Wednesday morning, 8:30 a.m., how they're going to actually fund that deficit. And if the Treasury Department decides that it's going to issue more long-term debt, so if they increase 30-year, 20-year, 10-year issuance by $3 billion a month over the next couple of months, that could really maybe at least have a knee-jerk steepening of the yield curve pretty dramatically. The Treasury Department, because of how high the deficits are, they have to continue to increase coupon issuance. Either that or they're going to issue so many bills that it's just going to overwhelm the market, I think. So there's going to be definitely a mix of bills and coupons. The question is, which coupons are they going to favor? And I think that they're going to still favor trying to issue more in the short term and the belly of the yield curve, so more 2s to 7s as opposed to 10s to 30s.
You know, Peter, this all goes to speak to risk at the short end and the long end of the curve. Draw us through asset classes. If rates stay higher for longer, if rates do what investors don't expect them to do, where do you see areas of the most risk right now?
Sure. Well, I'll start by addressing Ira's points. I agree. I think we're likely to see a steepening of the curve because, the Fed does not want to see any disruption in funding markets and doesn't want to overdo bill issuance. And it's really in a tough spot. And all of this, it presents a challenge, frankly, to risk assets. And, again, we've seen this 5 days in a row of new highs on the S&P 500 driven by, the Mag 7. And, so there's AI and there's everything else because, we don't see new highs in the Russell 2000, certainly. That's still 20% below its 2021 high. And interestingly enough, and, high yield, we've sort of seen yields floored on the CDX high yield index at about 350 basis points or about 106 on price. And that's pretty interesting to me because indeed, when we look at speculative grade loan defaults, for example, at about 3.6 or 3.7%, they've been creeping up very, very quickly. So there's some underlying on the default side. There's some underlying signs that some of the more highly levered, more economically exposed companies are at risk. And lastly, I'll say that even in earnings reports, when you look at DuPont or Intel or, name your sort of industrial company, 3M, it's a very different tone and tenor than those companies that are telling an AI story like IBM. Mm-hmm. So, I think that's a very important thing to keep in mind. And whether or not AI-related names continue to drag all the indices higher is actually an important sort of thing to consider relative to sentiment across all asset classes.
Peter Cecchini and Ira Josie, we have to leave it there. Very busy week ahead and a perfect setup for the next block, the auction block. We're going to talk about issuance. It remains hot, even amid all these risks. Procter & Gamble corporate sales set a spread record here. P&G. We'll talk all about that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, the block of the month. Issuance remains strong across the globe to start the year. In Europe, bond sales set a new record for January as they broke past the 300 billion euro mark. The surge was led by governments across the region. And here in the U.S., monthly high-grade sales sit near an all-time record, just short of the all-time January high at $170 billion nearly. Notable names this week include Lockheed Martin and P&G, which had the tightest 10-year corporate spread on record. And in high yield, after getting off to a slow start this year, the market is now on a tear, selling nearly $7 billion of fresh debt this week. And Thursday was the busiest session in 3 months. And speaking of issuance, Citigroup's Tyler Dixon discusses the hot pace of sales.
January year to date is off to an extraordinary start with rates where they are, with spreads where they are, and with pricing acting the way it's working right now, which is we're seeing primary new issues come through secondary prices, that's going to pull forward a calendar that we think is going to make sure that the first quarter is very, very busy on DCM.
And let's bring in just the perfect panel for this. Maureen O'Connor, Wells Fargo Global Head of High Grade Debt Syndicate, and John McClain, Brandywine Global Portfolio Manager. Maureen, maybe set the stage here. I know by Bloomberg's count we are near that record. By Wells Fargo, we might have already broken it. How much can this exuberance continue in the investment grade market?
I mean, at this point, it feels like the floodgates are open. I mean, all of the stars have aligned in January as far as investment grade market technicals are concerned. We have this environment where, you had really frothy returns right at the end of the year that brought in all of this new cash into the system. So all of these total rate of return accounts have been chasing what was very strong performance in the asset class right at the end of last year. But you also have an elevated yield environment continuing to encourage a lot of that LDI buying, pension funds and insurance companies continuing to lean into our market. So you have this demand dynamic that is overwhelming. So even though, yes, we are looking at a record supply month for the month of January in investment grade, it still feels like an undersupplied market. And one metric I would point to is, even though we are going to have record volumes in January, new issue concessions actually trended tighter over the month, and secondary spreads also trended tighter over the month. We're sitting at 2-year tights at the index level right now, right around 93 on the Bloomberg index, and some of our low beta stuff is trading at its all-time tights. And you highlighted the Procter & Gamble trade from earlier this week, tightest ever 10-year print going back almost 30 years. So we're definitely in very rare air in our market, and as far as I'm concerned, issuance is going to continue to come into this window until we see something really break down. And it feels like at this point we're not even up against a remote sense of market saturation or fatigue.
John, it begs the question, how much conviction is there for investors to step out of the purview of investment grade into riskier areas now that we're seeing spreads just so tight on the safe stuff?
Well, yeah, I mean, I think this is a risk-on type of environment, and we are seeing capital coming in from a variety of different sources, both domestically and international, into the market, particularly given where high yield is focused on the front end of the curve, and we have an inverted yield curve. So base rate plus low default type of environment means that we are seeing capital coming in, and we still think it's a reasonable time to deploy capital into high yield, especially relative to the valuations that we see in the equity markets. We anticipate defaults to remain very low in fixed rate debt over the coming, over the coming year here. It's a very supportive marketplace. We don't have a maturity wall. We don't have any particular sectors exhibiting meaningful default risk, and the names that are stressed are well known. So there's not a lot of jump risk, we think, in the market today.
Where do spreads go from here when you think about the future, Maureen? If you think about compensating investors who are investing in the safer part of the structure, particularly if they think things will start to turn south, how can they see toward the next couple months?
Yeah, I mean, it's a good question. I think one that investors are really struggling with right now, just given how lofty valuations are. It's certainly not a market that's pricing in anything that would even suggest recessionary headwinds are coming down the pipe. I think one of the things that is interesting, though, is if you look at how investment grade credit from a dollar price perspective has traded over the last 3 years, we have a lot more discounted debt in the broader market than we had 2 years ago, because we went through this rate shock over the last 24 months. So when you think about, spreads being at their all-time tights, discounted bonds drag spreads tighter. So there's actually more value at these ultra-tight spread levels on an absolute basis than perhaps what meets the eye. So said another way, even though we're getting into very rare air and spreads really aren't tighter on an absolute basis, less than 10% of the time if you look back over history, there is still some more room, I think, for this rally to kind of run or grind a little bit tighter from here. The downside scenario we also think is somewhat limited because we do still have an elevated yield environment, and even if rates do trend gradually lower over the course of the year, it's still going to be a good entry point for fixed income as a whole. So that's going to keep a lid on how much wider spreads can go if we do hit some of that economic slowdown. So I think a long-winded way of saying spreads are likely to be pretty range-bound here, and where there's value, much like John was just highlighting, is really in beta compression and buying the lower-rated names and trying to play that compression trade, which we saw through much of last year, but we expect to continue through at least the first quarter and maybe into the second quarter of this year.
Now, it's interesting, that conversation conversation I had with Citigroup's Tyler Dixon a little earlier. He pointed to the excitement about investment grade, but a lot of excitement about leverage finance. But when it comes to leverage finance, you have the private credit markets really looking to dive into that space as well. I caught up with Blackstone's John Gray a little earlier this week, and he spoke about the default rates that he's seeing. Take a quick listen.
Default rates in credit across our non-investment grade borrowers are less than 30 basis points. So we still see a very healthy market out there. What we do expect is that transaction activity will pick up and that folks like us in the private credit space are in a really great position to deliver for borrowers.
In just a minute here, John, are you convinced here that the default rates can continue to stay that low, particularly when you see S&P Global saying that they will tick up this year?
Well, I think they stay low in the private credit space for, kind of the next 12 months or so. We like to think about this as a three-stage type of marketplace where we're in stage one right now, which is covenant relief. We're seeing lenders working with borrowers, modifying covenants, giving time to potentially improve cash flow and balance sheet, given the fact that interest expenses moved materially higher because it's a floating rate marketplace. So with SOFR up 500 plus basis points, interest expense materially higher. Stage two, though, we think comes in the next 12, maybe 18 months, which is loan modifications. We're going to extend out the period of time to get paid. And given, again, the fact that you're dealing with private markets, you've got a little bit more flexibility from a lender's perspective. But after we go through all the financial engineering, we will see stage three, which is a meaningful uptick in defaults. We think that there is real stress brewing in private credit. It's just going to come very quickly. You're not going to see it, hence the fact that it's private in nature, but it's going to be delayed for a period of time. And really the other thing that I think investors in the public market have missed is in terms of default rates and the fact that private credit continues to provide capital.
John, we have to actually leave it there right now, but we'll have you guys back. Have to talk about both markets, particularly a very flush market for issuance heading into February. Those are for Real Yield, same time next week. This is Bloomberg.